Hi everyone, Steve Maxwell here, Hartford Retirement Planners. We've been getting a lot of questions from our clients recently with all the volatility in the market. So we just wanted to make a quick video that kind of explains a couple different charts and examples that might give you a little bit more peace of mind on why we continue to stay in the market even though it's, bouncing around a little bit. So the chart I have here looks back at the past 70 years. So you see a couple different colors on there. We have blue and we have gray. So the light blue represents intra-year highs. The dark blue represents when a year finished positive. The light gray indicates intra-year lows, and the dark gray indicates when we finished on a low year. So what do you notice first? There's a lot more blue than there is gray, that's for sure. So what we see is about every 3 to 4 years we have a down year. So what do you notice about the gray bars? Well, first off, there's some every year, which means that we typically experience declines annually. The other thing to notice about the gray bars is that the light gray is longer than the dark gray in all the cases. That just means that each year when we have an intra-year low, there's often some recovery that comes back from that point. So what does that mean for you as investors? It means we don't try to time the market. We want to be cautious about trying to sell when the market's down because we don't know if that's the bottom and there's some potential recovery that might still happen. And that we want to have a long-term approach to this because this is what you're getting rewarded for when you see your statements. It's the risk that you take on as investors. It's a little bit tough right now, it's a little bit painful, but long-term, it's what you're being rewarded for. Now I'm going to send it over to Joe. He's going to tell you a little story about the Dow Jones.
Hi everyone, Joe Conroy, and like Steve mentioned, I'm going to tell my Dow Jones all-time high story. So the Dow Jones, as you may already know, is just a mix of different companies and it changes over the years, but it's one of the oldest indexes. And when you hear things like the market's up 200 points or it's down 100 points, usually the financial industry is talking about the Dow Jones. So, little history lesson, the Dow Jones at one point hit an all-time high of 300 points. That was in the year 1954. Now, if we fast forward a period of time, we hit a new all-time high that probably was unthinkable back in 1954. 3,000 points, 10 times growth, 10 times more money, right? 10 times bigger market. That was in the year 1991. It took 37 years to grow your money by a factor of 10. Something happened not too long ago where we hit a new all-time high, another 10x growth factor, and the market hit 30,000. That was in the year 2020. All right? So that was only 29 years. It seems like things are speeding up, right? The drops are so much faster and the recoveries and the growth is also faster too. Things are certainly faster than they were back in the 50s. And if you look through this trajectory, it looks like the market's a very safe place to put your money. And over long periods of time, we believe it is. But what isn't reflected in these numbers are all the different things that have happened in between. The 9/11s, the 2008s, COVID is in this mix too, but there was a lot of things, civil unrest in the 60s and 50s, and there's just a lot of things that go on a day-to-day, month-to-month, even year-to-year basis. But if we stretch our thinking out longer, there's better days ahead. So what? When we look at this, what's the takeaway here? Okay, the market grows over long periods of time, but that doesn't really factor in all the different storms that we've had in between these all-time highs. 9/11, COVID, 2008, the market crash of 87 where things dropped 20% in a day. The list goes on and on. But what I can tell you is that all of those storms eventually ran out of rain, as all storms do. Currently, as of filming this in May 2022, we are in the middle of a storm. Hopefully, we're actually towards the end of the storm. Can't tell you that for certain. But this storm, in our opinion, will also run out of rain like every single one before it. So we just try to encourage that long-term investor mindset, and patience has been rewarded in the past. We believe that will hold true going forward. And you might think, Well, Joe, I'm retired or I'm close to retirement. I'm not a long-term investor anymore. I would like to share with you that maybe you're a little bit longer term than you think you are, you're giving yourself credit for. Because even though you might need money now, hopefully you're going to be with us for another 10, 20, 30 plus healthy, fulfilling years. And your money is going to last that long too, if we're doing our job right. So point being is you're probably a little bit longer term investor than you might give yourself credit for. Let's be patient. The storm will eventually run out of rain and there will be brighter skies ahead of us. As always, if you have any questions about your portfolio, whether you're a client of ours or not, please feel free to reach out to us. We're having these conversations a lot and we really enjoy trying to make sense of it for you, especially during these very difficult times. Thank you for watching.